Okay, today we are going to do a little summary session on introduction to accounting. So this part is very important because we will be learning about what are business transactions and what are accounting elements. So in accounting, it is very important to know about the accounting transactions as well as accounting elements. So what are the accounting elements? Those are assets, liability, equity, income, and expenses. So we are going to learn about business transactions as well as those five accounting elements. So when you look at a business have business transactions, and further business has different events as well. So business transaction is an exchange of resource between business and another party. There are two parties, that is the business and the other party. So exchanging resources between these two parties are known as exchange of resources. So in exchange of resources, we have two things. One thing is cash transactions, the next one being credit transactions. Okay, cash transactions means that you are giving cash or you are doing the settlement with cash right now. Whereas credit transactions are, you are not settling the transaction in cash now, but you will be settling the transaction in cash in a future date. Okay, so initially we have something called business transactions. Business transactions are exchange of resources between two parties. Okay, what are those two parties? One is business and the other one being the party that you're working with. Okay, so simply business transaction is exchanging resources between two parties. Okay, that is business and the other party. Okay, so maybe you are buying good. Okay, business is buying goods from this person and making the settlement. So when you're making the settlement, you have cash or credit. Okay, this entire transactions, it could be cash or credit. So cash transactions include selling goods for rupees 50,000 in cash, purchasing office supplies for rupees 5,000 in cash, paying rent of rupees 30,000 in cash, receiving payment of rupees 25,000 from a customer in cash. So all these cases you can see, okay, in cash. Whereas credit transactions are selling goods on credit for rupees 80,000, okay, providing services on credit for rupees 45,000, okay, buying inventory on credit for rupees 100,000. So you can see all the time you have on credit term, okay. So in a business, there can be various types of transactions. Okay, among these transactions of which their value can be measured in terms of money are considered in accounting. Itakota, now we are going to learn about, we are in the initial stage of accounting. Okay, so what do we take for the accounting? Okay, those are the transactions. What kind of transactions? Transactions where their value can be measured in terms of money. Okay, transactions of which their value can be measured in terms of money are considered in accounting. For example, let's look at this sale of inventory for rupees 200,000. Okay, so see, value can be measured. Value can be measured. Okay, monthly rent payment of 30,000, obtaining a mortgage loan of 1 million, water bill payment of 2,000. Okay, so you can see value can be measured. Okay, so other than these transactions, there are something called events. There are events that can happen in the business. This is not a transaction, but an event. And these events are also considered in accounting. And they are also, you can see, value can be measured in terms of money. Okay, now let's look at this theft of inventory. Inventory ka horakam karala. Okay, that is an event. It is not a transaction. Okay, write off an uncollectible buyer. That is an event. It is not a transaction. But we consider them in accounting as an event, and see, its value can be measured. Okay, its value can be measured. Now, what are the instances where you cannot measure the value? For example, let's say you are taking an employee or you are hiring an employee who has 10 years of experience in the industry. Okay, can you account it? No, you cannot. You cannot give a monetary value to 10 years of experience in the industry. Okay, that cannot be figured out as a accounting part. Okay, okay. Then then we are going to learn about assets, liabilities, equity, income, and expenses. So basically the accounting element. So we learned about the business transactions and events, which is the basic and initial part. And then now we are going to learn about accounting elements. Okay. So as a result of business transactions, following elements, accounting elements arise: assets, equity, liability, income, and expenses. So what happens? Because of business transactions, accounting elements are popping up or accounting elements are arising. So as a result of business transaction, business accounting elements arise. So what are these accounting elements? Assets, equity, liability, income, and expenses. So these are the 5 types of accounting elements. So this is very, very important, because for us to record any transactions, we should identify, okay, this is the asset. Okay, this is the equity. Okay, this is a liability, this is an income, this is an expense. So we should know about these things. Unless we identify an asset, if we do not identify asset as an asset, then our subsequent accounting entries will be subject to an error. For example, let's say you identify asset as a liability. Actually, there is an asset, but you identify it as a liability. Then your accounting entries will be in trouble. Okay. So now let's look at what is asset is. To understand what is asset is, there are sort of like different characteristics that are included in an asset. Okay, or else there are several characteristics that can be characterized in an asset. So resource that is generated as a result of past transaction is called as asset. So this is a resource which is generated as a result of past transaction. Okay. And the next thing is assets generate future economic benefits to the business. Assets generate future economic benefits to the business. For example, let's say you bought a stock. Okay, you bought a stock. You bought a stock means stock is the resource. So you bought it, that which is a past transaction. Okay, you bought a stock. So as a result of past transaction, you purchased a resource, which is a stock. So let's say you sell that stock. Once you sell that stock, you will get economic benefits. Okay, you will receive money to the business. Okay, you are buying a stock, keeping it or processing it, and you are reselling it. Then what happens? You are generating an economic benefit to the business. Okay, for an item to be identified for an item to be identified as an asset, it should be controlled by the business as well. Now, assets have another characteristics. Assets should be able to control by the business. Now, that stock I was talking about, okay, you should be able to do what? You should be able to control it. If you cannot control it, it is no longer asset. Now, a classic example to identify this or understand this is a building. Now, let's say you rent a building. Okay, you have a business and you rented out a building. Okay, is it an asset? No, it is not asset. It is not asset because it is not controlled by the business. Okay, so to identify an asset, there are several characteristics. So what are they? A resource that is generated as a result of past transaction. Assets generate future economic benefits, and they are controlled by the business. Further, to recognize these assets in accounting reports, accounting වලදී මේ assets record කරන්න, what should happen? Its cost or value should be able to measure reliably. That means now let's say you purchase a computer machine, okay, and you should be able to measure its value. For example, you bought it for 100,000, okay, then at the cost you can measure it. Okay, or else let's say you bought a stock. Now that stock is worth 200,000. Okay, its value is 200,000. Cost එක කියන්නේ ගොඩක් වෙලාවට අපි එක මිලදී ගන්න වියදම් කරපු මුදල. Value එක කියලා කියන්නේ අපි එක මිලදී ගත්තට පස්සේ ඒකේ තියෙන value එක මට ඊට පස්සේ මේක කීයකට විකුණන්න පුළුවන්. Likewise, okay? Then the definition of the assets, okay? So asset is a resource controlled by the business. Asset is a resource controlled by the business as a result of past transaction and from which future economic benefits are expected to flow to the business. Okay, this is very, very important. This is examinable and we should know this definition. Asset is a resource controlled by the business as a result of past transaction and from which future economic benefits are expected to flow into the business. So the following characteristics are observed of an asset. Arose as a result of past transaction, controlled by the business, inflow of future economic benefits to the business. So we already discussed about this. Okay. So among assets, there are two types of assets. Like assets gattamat, okay, assets gattamat, assets වල තියෙනවා types දෙකක්. Okay. Assets වල තියෙනවා types දෙකක්. So what are they? One being current assets, okay? The other one being non-current assets. So there are two types of assets. One is current assets, the other one is non-current assets. So assets that are expected to be used or sold or converted into cash within a short period of time are called current assets. එතකොට මොනවා හරි asset එකක් අපි ළඟ තියෙනවා නම් තා ලොකු කාලයකට අපි ඒක තියාගන්න. We are not keeping it for a longer period. We are either using it, selling it, or converting it to cash within a short period of time. Then we are calling it a current asset. A current asset. Then a short time period usually that is 12 months. Okay, that short time period is usually 12 months. Okay, so all the assets that cannot be considered as current assets are considered non-current assets. So on the other hand, what happens is these assets that you cannot classify as current assets are considered as non-current assets. So what are they? Land and building, machinery, furniture, equipment, and motor vehicles. Okay. So then let's learn about liabilities. Now, partly liability is the, other side of assets. ඒ කියන්නේ assets වගේම අනික් පැත්ත වගේ තමයි liability. එකම දේවල් තියෙන්නේ අර නිකන් අනික් පැත්ත වගේ. definition එක පැත්තෙන් ගත්තා ටිකක් අනික් පැත්ත වගේ. For example, let's look at it. Now, liabilities also have several characteristics. Similar to assets, liabilities also have several characteristics. What are they? Now, liabilities are an obligation that is generated as a result of past transaction. Okay. Now assets was a resource that was generated as a result of past transaction. But here, liability is an obligation that is generated as a result of past transaction. Okay. So what are the example? Bank loan, purchase on credit. So it's an obligation. You took a bank loan, a past transaction, and it's obligation. Now, liabilities generate an outflow of economic resources when settlement is made. Okay. Now, earlier we learned about assets. Assets, what happened? Assets generate future economic benefits. Now here, liabilities generate outflow of economic resources when the settlement is made. Okay. And then to show a liability in the account, its amount should be able to measure reliably. Now, similar to assets. Now, in assets also we told its cost or value should be able to value reliably. Similarly, to recognize liabilities in accounts, its amount should be able to measure. Okay. අපි ගත්තොත් එහෙම liability එකක් ඒකේ amount එක measure කරන්න පුළුවන් වෙනවා. So there are three main characteristics. Liabilities are obligations that are generated as a result of past transaction. Okay. Liabilities generate outflow of economic resources when the settlement is made. And to show a liability in the account, its amount should be able to measure reliably. Okay. So let's look at what is a liability. Liability, or the definition of the liability. A liability is a payable of the business that had arisen as a result of past transaction. A liability is a payable of a business that had arisen as a result of past transaction. Okay. So following characteristics are observed in liability. What are they? Arise as a result of past transaction and outflow of economic resource when the settlement is made, and having a current obligation. So you have an obligation. Now, similar to assets, there are two type of liabilities. Now, assets also, there were two types. Now, similarly, liabilities also have two types of liabilities. First one being current liabilities, second being non-current liabilities. The liabilities that are expected to be settled within a short time period are called current liabilities. So you have liabilities and you are expecting to settle it within a short time period. You call it current liabilities. Okay. This short time period is identified as 12 months. So this short time period is usually 12 months. All the liabilities cannot be considered as current liabilities, are considered as non-current liabilities. So a liability which cannot be identified as current liability is identified as non-current liability. Okay. So liability that is expected to be settled within a short period of time is called current liabilities, and this short time period is usually 12 months. And liabilities that cannot be considered as current liabilities are considered as non-current liabilities. So we learned about liabilities and assets. Okay, assets and liabilities. So we learned about accounting transactions, assets, and liabilities. And next we learn about uh, equity, income, and expense. Okay. Okay. So let's move on to the other slides. Okay. Now let's learn what is equity. Okay. Now we are going to learn about the equity. So if a business has liabilities, after settlement of those liabilities, the assets that are belonging to the owner of the business is equal to the equity. Now let's say now we already talked about these businesses, and let's say I am running a business. At one part, I understand, okay. The first thing is uh, I have 100,000 rupees and I put it and I start the business. And at one point, I understand, okay, this business cannot grow with 100,000. So I need borrowed money. So I go to a bank and take another 100,000. Now, if you look at this business, there are two parts. One thing, the assets that I put, that is 100,000, my saved money that I put into the business. The other thing is the liability, which is 100,000 loan. Okay, keeping this in mind, let's look at this case. Okay, so now, in equity, one thing we understood or we already did, if a business has liabilities, after settlement of that liabilities, the assets that are remaining belonging to the owner of the business are equal to the equity. So, if a business does not have liabilities, the assets of the business are equal to the equity. Okay, now let's jump back to that 100,000 example I told. The first case, the first few days or first, let's say first month, I had 100,000 and I put it into the business and I started the business. Okay, I had 100,000, I put it to the business and I started the business. They are, okay, that 100,000 is the equity because it's my own money. I never borrowed money from anyone. Okay, business does not have liabilities in that case. Now, the second case, I go to a bank and take 100,000. There, what is the equity? So I have first my 100,000. Okay. I have my 100,000, my saved money. And then, secondly, I have that money I took from a bank loan. Okay. Now, here the equity is, okay. Now we are looking at what is equity. Now you see here, it's 200,000. But equity is the amount that is remaining after settlement of this 100,000, which is the bank loan. Okay, which is the bank loan. So there also equity will be 100,000. Okay, so let's go to this example. Let us assume that a business has 500,000 worth of assets and a bank loan amounting to rupees 200,000. Okay, then rupees 200,000 out of this 500,000 worth of assets has to be used to settle the bank loan. Therefore, the remaining assets worth 300,000 belong to the owners. Now, there is a business which has 500,000 worth of assets. Okay, And also in this business, there is 200,000 worth of a loan. Laksha pahak assets thiyano, laksha dekak loans thiyano. Now we want to figure out what is the equity. Okay, very simply, to figure out the equity, I have to settle that loan amount. I have to settle that loan amount from what? With the assets I have. So what I do is I have 500,000 worth of assets, and I said I will sell off 200,000 and I will settle that loan. Then I have 300,000 worth of assets, and that asset is the equity. Okay, after settlement of a liability, the amount of assets that are belonging to the owner is the equity. So in a solve prop, now here in this calculation, you can figure it out. You have equity is equal to asset minus liabilities. Asset is 500,000, and then you reduce 200,000, and then you have 300,000 worth of equity. Okay. In sole proprietorship, the capital invested represents the equity. In sole proprietorship, the capital invested represent the equity. So let's look at the definition of equity. The value of an asset, the value of an asset that belong to the owner of the business is termed equity. The value of an asset that belong to the owner of the business is termed equity. Okay, so we learned about assets, liabilities, and equity. Okay, and now we are going to learn about income and expenses. Okay, the remaining two accounting elements. Okay, so to understand about income and expenses, we should also understand about profits. Now, profit is the difference between income and expense. Okay, profit is the difference between income and expense. Now, the important thing about profit is belonging to the owner of the business. Okay, profit is belonging to the owner of the business. So, since it is belonging to the owner of the business, we are adding it to the equity. Okay, because equity is the actual ownership of the businessman in the business. Therefore, we add the profit. So profit can be calculated separately and added to equity. Okay, see here. Now here we learned the earlier example. Okay, here we learned equity is equal to asset minus liabilities. Okay, now here I took it. Equity is equal asset minus liabilities. Okay, then assets of the big business includes the summation of equity and liability. Okay, then again this initial formula, equity is equal to assets and equity is equal to asset minus liabilities. No, sorry. Now I said, now profit is belonging to the owner, therefore you add the profit to the equity. Okay, you add the profit to the equity. So assets minus liabilities. See, you have equity, which is equal to asset minus liabilities. And since profit is belonging to the equity, what you do is you add the profit to equity. Profit එක අයිති equity එකට නිසා එහෙම නැත්නම් profit එක අයිති owner ට නිසා ඔයා profit එකත් equity එකකට එකතු කරනවා. Then equity plus profit is equal to asset minus liabilities. Alternatively, income can be added to the equities and expenses can be deducted from the equity. Then අපි මේ profit කියන එක earlier now we now what is this profit? Profit is income minus expenses. So without writing this profit term, we will write it as income minus expenses. Okay. Now here you can figure out what happens if income goes up. If income goes up, then equity will go up. Okay, if income goes up, this final part, if now this final part, let's say this is okay, this is the ownership of the owner, equity. Okay, if this income goes up, what happens is this entire part, it will go up. Okay, and then let's look at here. Now let's say what happens if expenses go up. If expenses go up, what happens is this entire part will come down, equity will come down. Okay, so if income goes up, your equity will go up. So on the other hand, if expenses go up, your equity will come down because income is this is plus 1. If it is plus 100, it will go by plus 100. But if it is minus 100, it will go down by minus 100. Okay. So equity is increased by the income and decreased by the expense. So what happens? Equity is increased by the income and decreased by the expense. Okay. An accounting equation, we can also take it as assets is equal to equity plus liabilities plus income minus expenses. Okay, now we are going to figure out what is income. Now we learned with the income, equity is increasing. And with the expenses, with increasing expenses, equity is going down. Now, when you look at the equity, okay, when you look at the equity, okay, when you look at the equity does not go up only when you have higher income. There is another case. If you introduce capital to the business, then also equity is going up. Okay. If you introduce capital, if the owner brings new capital to the business, then also equity is going up. Okay. Then when we decipher the definition of income, income can be defined as increase in equity, as we agreed. Okay. Increase in equity. Income goes up, equity goes up. Income can be defined as increase in equity, but other than due to increase from capital introduced by the owner. ඕන කැපිටල් එක ගේන්න එක ඕන කැපිටල් එකක් ගේන සිටුේෂන් එක ඇර යම් ට්‍රාන්සැක්ෂන් එකකින් ඉක්විටි එක වැඩි වෙනවා නම් අපි කියනවා ඒකට ඉන්කම් එකක් කියලා. If a transaction increases the equity of the business, we call it income. Okay, but this particular scenario can not be a situation where owner is bringing out capital to the business. So what are the examples for the income? Those include sales, interest received, rent received, and commission received. Okay, so those are the 5 things. Then understanding expense. Okay, now understanding expense. So we learned if expenses is going up, then your equity is coming down. Okay, we learned if your expenses is going up, okay, this is a negative figure, therefore your equity will come down. Okay, your equity will come down. So expense is a situation where equity is coming down. Okay, but there is a important or there is a unique situation where owner can take money out of the business, money or materials out of the business. We call it drawings. In that situation also equity is going down. Owner business eකට ගිහිලා owner goes to the business and takes money out of it. We call it drawings. Drawings කියලා කියන්නේ owner business එකේ තියෙන සල්ලි එළියට ගන්න එක. Drawings mean owner is withdrawing money from the business. Okay. Sorry. Sorry. Okay. Now, there is a particular situation where owner can go into the business and take out the money. Okay. Owner is going to the business and taking out the money. When he does that, we call it drawings. What are drawings? Drawings mean businessman, the owner of the business, is taking out cash or goods from the business. Okay. When drawings happen, equity is going down. Okay. That situation we do not identify as an expense. But if a situation or if a, not a situation actually, if a transaction reduces equity, okay, if a transaction reduces equity, we call it a expense. So expense can be defined as reduction in equity due to except due to the drawings. So expense can be defined as reduction in equity other than drawings, except due to the drawings. Okay. So with that, we learned about expense. Okay. So we learned about few things. Okay. Very important things. We learned about business transactions. Okay. We learned about cash transactions and credit transactions. And then we learned about accounting elements. Okay. As a result of business transactions, accounting elements arise. So those are assets, equity, liability, income, and expense. Okay. And we learned about the characteristics of assets. Okay. Very important and examinable. And then we learned the definition of assets. Very important and examinable. Then we learned about the types of assets, very important and examinable. Okay, then we learned about liabilities, the characteristics of liabilities and definition. Okay, and then types of liabilities. Okay, very important. Then equity, we learned about the equity. We learned the definition, very important, and how to calculate equity. Okay, calculation of equity, very important. And then we learned about income and expenses. Okay, we learned about income and expenses. So that's it. And those are, so as I explained, those are very important, and learning about these things are very, and learning and remembering those things are very important. So as I said, you should prepare a mind map for this as well. Okay, earlier also I explained how to prepare it. I ask you to take a A4 sheet and divide it to two. So it's simply like this. You take the A4. This is your A4, and you bend it. Okay. So you have four parts: one, two, and backside, three, and four. Okay. This is how I used to study, and it worked out for me. Now what I do is, now firstly, I I write as business transactions. So you have to write it, and then I divide it to two, credit and cash transactions. Then I name it as accounting uh, elements, and then I write assets, liability, equity, income, and expense. So under assets, I write characteristics. Or else firstly, I will write the definition. Okay, then I write characteristics. And then I write current account and current asset and current liability. Okay, I will write about those two. Okay, then I have liabilities. I will firstly write about so I will write liabilities, and then I will write about first the definition, then characteristics, then current asset and current liability. Then I have equity. I will write the definition and equation. Okay. Then I have income. I write about the definition and other important things. Then I have expense. I write the definition and other important things. So likewise, often either this page or four pages, you have all the summation of what is an asset, what is a business transaction, what are accounting elements. Okay, likewise you have the summary. So do prepare it, and with that we conclude this session, and thank you so much.